Hey, welcome back to Two Super Guys Trade Stocks. I'm Dylan.
And then I'm Vinny, and holy crap, right now is feeling goddamn good. You know, your personal net worth is sitting at an all-time high, and I'm going to revisit a little Michael Burry kind of thing from last year, talking about market bottoms and timing around bankruptcy and ETFs. We're going to talk about whether or not that actually holds any water, give you a general overview of the economic cycle and where we're at right now. With that, we'll get to it.
Two Stupid Guys Trade Stocks.
So,
I forgot
is
to
this
say.
going to last?
Yeah, that's the real question. I mean, I forgot to mention our girl Nancy Pelosi. She's loading up on stocks, so it's probably a good sign. Once you see her historical performance, it is insane. Okay, she's way better trader than Burry. That's all I got to say.
She's a better trader than everyone because she cheats and lies.
Yeah, I know, right? So this is the full tweet we're kind of referencing here, where he was talking about kind of stock market bottom and bankruptcy filings, right? So we're going to look at bankruptcy filings and kind of updated in terms of coming into this year and where we're at in that cycle. Basically, every time you get a tightening of economic kind of circumstances a little bit, you shake the chaff out, right? The crappy companies can't survive and they just die off and file bankruptcy. And then the good companies consolidate and own more of the market now after that. That's just generally how economic cycles work, right? So you are seeing a pretty significant increase in bankruptcy filings. This is commercial Chapter 11 filings. 68% increase in the first half of this year. That's a scary trend, is it not?
So, the question is, how many of these bankruptcy filings are from, sorry, quote, bullshit companies that spawned in 2021, like Nikola, and I always forgot his name. Financial.
Jeremy, tattooed chef. I think that's who
That
you're
one.
thinking of. Because they got delisted this week.
Yeah. So, like, how many of those are those where money was so cheap they shouldn't have been a company in the first place?
Oh yeah, there's 8 million of them, right? Like all those SPAC ETFs or SPACs in general, the that didn't deserve to exist. But you have to put this in context, right? We have to go back and look at where we are in the whole cycle. So at 68% year over year sounds like a really large increase, but when you look at kind of going back here, bankruptcies were not a major thing for the last couple of years. Money was so cheap and plentiful that companies that didn't have any real products could get $10 million in funding. That's why bankruptcies were so rare. That the 68% gain is because them coming off the bottom or absolute ridiculous low in a easy money market environment, right? So we're going to see a little bit different
Are
shape of
these
that, I guess.
are those numbers? Were those the numbers of bankruptcies?
Yeah, so this is bankruptcies total, I want to say. This includes personal bankruptcies as well as corporate ones. The
Oh,
previous slide
okay.
was just corporate ones
Got it. Got it.
from
Got it.
commercial
Got it.
Chapter 11. This one, I can't remember. I think this is just commercial ones, but I'm not entirely sure on that one. But you are looking at a little bit of a hookup here recently, but you're nothing compared to the actual dramatic spike we saw after the following 2008 financial crisis. So, and we also did a separate video looking at the timing of the peak of bankruptcies compared to the stock market bottom, and it's a useless indicator because it's lagged significantly behind. I want to say it was like 12 or 15 months, somewhere in that ballpark, behind when the actual stock market bottom was. So this is not a good indicator if you're
Yeah.
trying to time the market a little bit,
No, not at all.
which is also
And
stupid.
timing the market is the correct thing to do, as we learned.
Totally, 110%. Always time everything. Uh, that's a joke.
You
Yeah.
want me to show mine
Um,
here?
But this is the wild part to me is we're going to talk a little bit about some of the headwinds facing the U.S. economy. But right now, you just look at the two major indices here, SPY and Triple Q, and they just look like powerhouses, man. Just look at that. You got all four of the moving averages, or three on this particular graph, lined up underneath it in order. You got a sexy looking upward trend there as far as like a channel. It's how do you fight this? Like it's insane.
Yeah, here's the cues. Let's just do a weekly graph. It's just like nonstop. It's actually super extended from the 9 EMA here. This is weeks. So usually after about here, it would have corrected itself. But I mean, I'm going to move my face here. You can just see, oh, that's the graph. There we go. Even on the down days, the volume is nothing. All the volume is pushing it upwards.
Well,
So
we are in July. This
we
is
are in July.
typically a lower volume season, so like that makes sense.
But I mean, just the point of the higher volume days, as in hitting average volume, are straight white bars. and the low volume days are red. So
Mm,
we're pushing very high. It just seems relentless. Like it's just
yeah,
wild.
just too legit to quit. To quote, I forget what the name of that rapper is, but it seems pretty real to me, man.
Guy from Hot Rod.
And then if you want to put the actual numbers behind this year, 18% on the SPY, double the almost double the historical average, right? Usually 10 to 11% per year is about what they run, over the last 100 years in the ballpark. And
43.
40% on the triple Qs.
Holy crap! How much of that is Apple, Microsoft though? That's
That's
like
an interesting
probably a
question. I
lot.
didn't take that graph out. It is a huge portion of it, like 92% or more. It is concentrated in a matter of a few names, of which fortunately, at least Apple was my largest holding, still is right now.
Jesus.
And then, this is a good sign. Speaking of Apple, you remember Nancy Pelosi, the little Speaker of the House,
Yeah.
controller of everything.
Can you
Um,
explain her relationship with her husband? Because she made mirrored trades with her husband. So her husband did this, and then she did right after.
I'm
With,
not sure. He does most of the trading, as far as I'm aware. I'm not
but
aware of her doing separate
I
transactions.
thought it was two different accounts. Let me look it up while you're doing this.
I can't speak to that. I can tell you, she says that most of the trading is done by him. He is historically kind of more the investor in the couple, but the old joke is talking about how look at how much she's like outperformed the SPY from this chart right here. Just takes a little snippet here, but she absolutely crushes the average, right? Look at Dow Jones Industrial Average right here was doing pretty well, but she was still doing significantly better on her options and better overall. It's just insane to see her outperformance of the indices.
I'm wrong, by the way. Just forget that I just said that. I'm spreading false
Okay.
information.
Yes.
Uh,
Yeah. What do
yeah,
they call that?
I mean, this is not even fair. I don't understand how this is legal. I don't get it.
No, someday they might actually fix that. Probably not because it's not in their financial best interest, but someday someone might. But this is what you're talking about news article wise. He loaded up on $2.6 million in Apple and Microsoft stock by exercising a bunch of options he had already purchased. Granted, it was probably well in the money based upon like the timing of the options that he had purchased and the stock moves since then. So he's caught a significant portion of these gains over this last couple months. So I think I want to say they bought the options in March, if I'm not mistaken, and it was for June expiration. Then they went ahead and exercised them all. Yeah.
I
Mm-hmm.
just
I see.
look. This is not what this video is about, but I get investing. But options, if you're in Congress, like, dude, there's got to be a line. Like, come on.
Yeah, I get what you're saying. Yeah, let them own some index funds or something like that.
Yeah.
So we've done a separate video about this as well. But the Buffett indicator, right? This generally just tries to show how cheap or expensive stocks are relatively in the U.S. at this particular point in the economic cycle. And we did kind of get back down towards like a reasonable within one standard deviation, right? For people that aren't really into like math, but this is basically representing a bell-shaped curve, and it tells you how far away we are from what should be expected based upon a random sampling, if you want to think about it that way. And where we are right now, 1.5 standard deviations away from the actual historical average here, is saying that like, the market's kind of a little bit on the fringes still. We did come back towards a little bit more towards the middle, where it would be expected to be 68% of the time, but we're now starting to move back out a little bit, where we're getting towards, it's due to standard deviations of the 95% confidence interval. So meaning 95% of the time, it should be within that balance, and we're kind of closer to one than we are the other, if you will.
I just you got to think like how much of this is just like five companies. Like that's something that we should look, because it's just Apple just hit 3 trillion and then kind of blew past it, and then they went back down though, right?
What's interesting though is this wasn't designed to be part of this video, but I just listened to both the JP Morgan earnings call and the United Health earnings call, and they're both basically just saying like, dude, we're crushing it. Like there's just easy money out there to be made is the tone I got from both of those earnings reports.
Yeah.
They both crushed top and bottom line. We're starting to get earnings reports finally now from Q2 2023, and companies are still doing very well. So there's plenty of signs here that the economy is still doing well enough to continue to support these kind of elevated valuations.
Yeah, I mean, I'm glad that I closed my options when I did, because that would have been really bad now.
Yeah, that is true. So Michigan consumer sentiment, roughly 70% of the U.S. economy is based upon consumer spending. And, this is used as like a forward-looking gauge of how confident people are in going out and taking a debt on and doing aggressive things in order to, continue making the economy grow and spending money. We did hit like a new all-time low earlier this year,
Mm-hmm.
but we've kind of rebounded from that level. Just we haven't seen the economic downturn yet, as kind of shaded by these gray areas here, which is the indicator of prior recessions. So yes, consumer sentiment downturn usually does precede that, but we have yet to enter one following that new all-time low in consumer sentiment. So maybe Jay Powell, when he says this time is different, he has something accurate to say there.
I trust everything he does.
Yeah.
Ooh, this is
And
interesting.
yeah, this is another one that's kind of funny. So this is looking at delinquency rates. All right. This isn't the freshest data because unfortunately it takes a little while to kind of contabulate or this sort of data. I made that word.
Contabulate.
Yeah, exactly. But you're starting to see a little bit of a hook effect here in a couple of these things. Yeah, sir. There are plenty of pictures up there online of repo car lots being now full of cars, and people talking about how many no sales there are at car auctions. That's another indicator that we're starting to see a little bit of softening here. Wholesale auto prices finally dropped significantly. I guess last month it was like 10% or something like that. It was in the double digit territory, I want to say. So some definite signs of softening in the consumer kind of risk category. We still have this ridiculous low rate of student loan delinquency because we're not paying them.
It was artificial. Yeah.
Yeah. I mean, I hate to see what that shape is gonna look like after the pause kind of ultimately, falls off to September.
Is it September?
Yeah.
I don't know.
Close.
Hopefully people have been smart.
It's close. Yeah.
Jeez.
And
What?
if you really need some confirmation about the softening of the economic market, this is the Rolex Market Index. All right. I don't own any high-end watches, but I always kind of follow it because they do interest me.
Of course you do.
The values just went insane during the pandemic. As you watched on here, this is August 2020. So the Rolex values basically look like a meme stock. Did you realize that?
Yeah, no. At no point would I have thought to ever look at this chart and then compare it with like economic factors. So what a random.
Yeah.
Okay.
Yeah, it's still elevated from where it was pre-pandemic. I mean, look at this. This is like 22,000, right? It shot up to a high of 38,000. This is based upon like a market. A basket of 10 the most popular Rolex models or something like that. It's something that's calculated. But it does kind of represent the valuations of these, and it almost doubled from pre-pandemic to actual peak. And now we've come back down to like 50% off the peak, but we're still well above we were pre-pandemic levels as far as pricing goes on fancy watches.
Okay. All right. I will probably never own one of these.
At the higher end of the economic kind of ladder have felt a little bit more pain. That's my point here.
What a wonderful point that is. Okay.
Yeah. And why, right? Look at the inflation. People are cheering this week because CPI came down, was like 3%. Right. But what Powell has talked about is that the headline number only tells you part of the story. And we knew the headline number was going to come down. Mm-hmm. But you're still seeing the actual core inflation has been pretty sticky. Sticky. So the core inflation here is this red line. And if you look at that one, it's come down slightly, but nowhere near as dramatic as the blue line, which is the overall one. And that's the one that matters more for American households on a day-to-day basis is kind of the thought process behind the core inflation.
Right.
Still running at double the rates they want to see.
Okay? Yeah. Hence the 2 rate hikes upcoming.
Yep, probably 2 rate hikes coming up. I'm going to show you the chart of that actually here in a second. And don't forget, we still have personal savings rates are pretty low. Okay, not the lowest we've ever seen, but short of right before the great financial crisis. This is still consumers hurting a little bit here. They're not having a lot of extra money to save up in their bank account, even though they're offering 4% right now. That's sexy. I'm pretty happy with the 4% I'm earning right now in my savings account.
Yeah. Also, someone asked me that in a comment. Yes, I moved all my savings to Robinhood to collect 4.65%.
Nice. I'm with Discover. I think right now I'm getting 4.1, I want to say.
Nice. Solid.
Yeah, exactly. I also got like a $200 sign-up bonus or something like that. This is the Fed meeting probabilities. Like we were just talking about the 2 rate hikes. So we are in this 500 to 525, like basically range. So we're looking at another 25 basis points they're expecting for this month. 96. And then potentially another one here in September. It's kind of like what the market is pricing in right now.
Yeah.
Even, kind of right here is kind of another one that it's potential as of this day, it could actually happen for the December meeting there as well.
I would agree with that. if Nancy Pelosi's buying stock, that's the only indicator I need. Bull market for the next year, new highs. It doesn't have to make sense. Doesn't make logical sense at all. But I think it's going to happen.
I hear you, man. All right. Catch you in the next one.
All right, guys. Don't forget, contabulate it. Okay? All right, bye.